Every time you buy a US stock, 1.5% disappears before you own a single share. On $10,000, that is $150 gone. On a 20-year portfolio, that quiet fee costs you over $8,000. And here is what nobody tells you. There is a way Canadians are avoiding this fee entirely, but there is one catch almost nobody talks about. First, we need to understand where this fee actually hides and why your broker never shows it to you. Then, we are going to follow the money on a real portfolio and watch that 1.5% compound into thousands. Third, the 3 paths Canadians use to fight back, and the catch hiding inside each one. Fourth, the net math that tells you which path actually wins. And fifth, the one move that eliminates the fee on US stocks entirely. 5 boxes. Let us open the first one. Box 1. Where the fee hides. When you buy a US stock from a Canadian brokerage account, your Canadian dollars need to become American dollars before the trade executes. Your broker handles that conversion, and they charge you for it. The fee is not a line item on your trade confirmation. It is not on your monthly statement. It is baked into the exchange rate itself. Your broker quotes you a rate that is worse than the real interbank rate, and the gap between those two numbers is your cost. On most Canadian platforms, that gap is 1.5%. Wealthsimple charges it on every conversion from the CAD account. Questrade charges a comparable markup. It is the industry default. Here is what that looks like on a normal contribution pattern. Say you are putting $500 a month into an example index ETF like VOO, standard self-directed TFSA. $500 is the base figure we are going to track through this whole video, because that is roughly what a lot of Canadians actually contribute on a monthly plan. On that $500 trade, the FX fee is $7.50 every month. On a $10,000 lump sum, it is $150. You never see the charge because it never shows up as a fee. It shows up as a slightly worse price. They do not hide it in the fine print. They hide it in the math. And that is the cost on a single trade. It sounds small, but the next box is where that number stops being small. Box 2. The compounding damage. Meet Sarah. She is 45, lives in Ontario, earns $85,000 a year, and invests $500 a month into VOO through her self-directed TFSA. Solid plan. One problem. Every month, 1.5% of that $500 disappears into the FX spread before a single share lands in her account. That is $7.50 a month, $90 a year. $90 does not sound like a retirement problem, but Sarah is going to do this for 20 years. Over 20 years, the direct fee adds up to $4,900. That is just the money skimmed off the top. But the real damage is what that money would have earned if it had stayed invested. Every dollar the FX spread took in year 1 had 19 more years to compound. Every dollar it took in year 5 had 15. At a 7% average annual return, the lost compounding on those skimmed dollars adds another $3,100. Total cost of the 1.5% FX fee on Sarah's portfolio, $8,000. Same contribution, same stock, same time horizon. $8,000 gone because of where her broker set the exchange rate. Not because Sarah picked the wrong fund, not because the market dropped, because of a fee she never saw on a single statement. That is the number everyone should know before they place their next US trade. $8,000 is the problem. The question is what to do about it. There are 3 paths, and they split in the next box. Box 3. The 3 paths. Quick disclosure before we compare. Moomoo is the paid sponsor of this video. Wealthsimple is an affiliate partner of this channel. Each link earns a commission. The comparison ahead is based on each platform's published fee schedule, not affiliate incentives. Path 1. Norbert's Gambit. You buy a dual-listed ETF on the Canadian side, journal it to the US side, and sell it in US dollars. You convert your currency through the stock market instead of through your broker. The FX cost drops to near zero. The catch: it takes 2 to 5 business days for the shares to journal. During that time, the ETF price can move against you, and not every brokerage makes the process easy. Some charge journal fees, some make you call in to request it. Great strategy on paper, a lot of moving parts in practice. Path 2. Interactive brokers. IBKR gives you the actual interbank exchange rate, plus a tiny commission, about $2 on a $10,000 conversion. Based on their published pricing, that is a very tight conversion cost. The catch: the platform is built for active traders. The interface is dense. The learning curve is steep. If you are a buy and hold investor who wants to log in once a month and buy VOO, this is a lot of machinery for a simple task. Path 3. Moomoo. Moomoo currently waives the explicit FX conversion fee. Your Canadian dollars convert at their preferred market rate, which does include a small embedded exchange rate spread, but no percentage fee stacked on top. The catch: Moomoo is not commission-free. You pay a minimum of $1.99 per US trade, and the waiver is current policy. It could change at any point, so the 20-year math only holds if you expect it to keep holding. Moomoo may be new to some of you, but it is backed by Futu Holdings, a NASDAQ-listed firm serving around 29 million registered users globally across its platforms. A new Canadian footprint on top of a much larger parent company. 3 paths, 3 catches. But the only way to know which one wins is to put real dollars on the board. That is the next box. Box 4, the net math. Same scenario. Sarah, $500 a month into VOO, 20 years. Let us run the numbers on all 3 paths, assuming the current waiver on Path 3 holds for the full period. Path 1, Norbert's Gambit. Near zero FX cost if you execute it cleanly every single time, which, in real life, people do not always do. Journal fees vary. Market risk during the settlement window. Path 2, Interactive brokers. About $2 per 10,000 converted. Over 20 years of monthly $500 contributions, total FX cost is roughly $48. Negligible. But you are running a professional-grade platform for a buy and hold strategy. It is like buying a race car to drive to the grocery store. Path 3. Moomoo. Zero explicit FX fee while the current waiver is in place, with a small embedded rate spread on top, plus a minimum of $1.99 per US trade. Over 20 years of monthly purchases, the commissions alone add up to about $480. Add the rate spread and call it somewhere in the $500 to $600 range total. Again, assuming the waiver holds. Now, compare that to staying on the 1.5% default, $8,000. Looking at what each platform publishes on their own pricing page, Wealthsimple charges a 1.5% FX fee, and Questrade charges a comparable markup. Moomoo currently waives its explicit FX conversion fee. On a $10,000 US stock purchase, that is roughly $150 in cost you do not pay on Moomoo today. The gap between any of the 3 alternative paths and doing nothing is over $7,500. Even Moomoo, at roughly $500 to $600 total over 20 years, saves Sarah over $7,000 compared to the default. And if you lump sum invest instead of buying monthly, the per-trade commission matters even less. The algorithm only pushes this to other Canadians if you engage. Likes and comments are how this stays visible, and that sets up the move that closes the gap. Box 5. Eliminating the fee. You just watched $8,000 disappear from Sarah's portfolio over 20 years. The question is, which tool matches your strategy? If you want a hands-off, managed portfolio with automatic rebalancing and tax loss harvesting, Wealthsimple is built for that. Their managed investing service handles the whole allocation decision for you. Separately, Wealthsimple also offers self-directed accounts with zero commission on stock and ETF trades. Different strategy, different tool. If you are paying that 1.5% FX fee, you are literally losing money every time you buy US stocks. There is a link below if you want to look at Moomoo and see for yourself. Moomoo currently waives its explicit FX conversion fee. Your CAD converts at their preferred market rate with no percentage markup stacked on top. You pay a minimum of $1.99 per US trade. On Sarah's $500 monthly purchase, that commission is well under 0.5%, and a per-trade commission does not compound the way a percentage of principal FX fee does. You decide whether the FX savings make sense for your situation. On safety, Moomoo is CIPF protected and CIRO regulated. That is the same oversight framework every major Canadian broker operates under, with CIPF covering up to $1 million per eligible account in the event of broker insolvency. Available account types include RRSP, TFSA, and spousal RRSP. Moomoo is currently running a welcome promotion for new clients. $60 in stock coupons on a $1,000 deposit, or $300 in stock coupons on a $5,000 deposit. You can fund the account via Interact e-Transfer. A 90-day holding period applies. Full terms on Moomoo's website. Here is what Moomoo does not do. It does not offer managed investing. It does not do automatic rebalancing or tax loss harvesting. It does not offer FHSA, RRSP, or joint accounts. The platform is newer to Canada than Wealthsimple or Questrade, and it is still building out some features. And the FX fee waiver is current policy. It could change. The link is in the description. That covers the tools. But there is one more cost hiding in your portfolio that has nothing to do with fees, and it is draining RRSP holders right now. Let us put the full picture together. The 1.5% FX fee is the default at most Canadian brokerages. It does not show up on your trade confirmations. It does not appear on your statements. It just quietly compounds year after year, turning $90 a year into $8,000 over a 20-year portfolio. There are 3 ways to find it. Norbert's Gambit, if you want full control and do not mind the settlement window. Interactive brokers, if you want interbank pricing and can handle the platform. Or a broker that currently waives the explicit fee if you want the simplest path for monthly US stock purchases. The math is not complicated. The fee is real, it compounds, and most Canadians never notice it exists. Now you do. Subscribe so you catch the next one before it costs you. If you are holding US stocks in your RRSP, there is a second cost most Canadians miss entirely. It has nothing to do with FX fees, and it hits every single year you hold those shares. The IRS withholds 15% of every dividend paid on US stocks inside a TFSA. Inside an RRSP, the Canada-US tax treaty shields the dividend from that withholding, but the wrong account type quietly drains your returns in the background year after year, and most investors never spot it. That is the next piece of this portfolio puzzle. The RRSP mistake costing Canadians $3,000 every year. Link is on screen. Watch that one next, and you will see how the account you hold your US dividends inside can cost you more than the FX fee we just walked through. Not your accountant. Do your own homework. Thanks for watching.